Welcome back, lads. Today we are going to check out a bunch of the different ways that the new tax laws actually impact millennials. If you enjoy the video, please drop a like down below, subscribe. This will let you know when we release new videos every single week. Plus, it will help us reach our goal of hitting 100 subscribers, which would be a huge milestone. That would feel amazing. So thank you for your support, and let's get right into it. So you might have heard about the tax laws that were enacted back in 2017 called the Tax Cuts and Jobs Act, TCJA. This is literally one of the biggest changes to our tax system that we've had in decades. And I mean, some of these changes are good, some of them are bad. There's a bunch of changes that were made, and some of them are gonna help millennials, some of them are absolutely gonna hurt millennials. And two of the biggest changes that were made were the thresholds for tax brackets and changes that were made to potential deductions and exemptions. And all of these changes are kind of unique in that they are not permanent, they're like semi-permanent. So they went into effect in 2018 and they will last until 2025. After 2025, the entire tax system is going to revert back to what it was. So the tax bracket thresholds were actually lowered by these laws. And at the same time, the standard deduction on your taxable income was increased. So there's a little bit of back and forth and they kind of offset each other somewhat. But this leads to a potential method for essentially saving more money when it comes to filing your taxes, and that's with itemized deductions. But even with that, there's a caveat, because for your itemized deduction to be more valuable than the standard deduction, it needs to be valued as less than the standard deduction. So if you work through your itemized expenses and it turns out to be more than the standard deduction, then you absolutely don't want to do that. You'd be losing money. You just want to take the standard deduction and then just leave it at that, because you're going to get more back through the standard deduction than you would by going through the work of itemizing your expenses. Oh, this is also actually more valuable if you're filing single or married jointly. So for like 2021, the standard deduction was $18,800, and if you filed married jointly, it was $25,100. So as long as your itemized expenses is less than that, you'll actually make more money by simply itemizing your expenses. And then to offset that, they got rid of personal deductions, and that's $4,000. Well, it's the potential for $4,000. So that's straight up gone now. The child tax credit, CTC, got a bunch of improvements. Like the phase out limit was literally almost quadrupled. A phase out, in case you don't know, that's like essentially the amount of annual income that you make. If you make like more than that, then you're no longer eligible to receive that tax credit. And depending on the amount of tax liability you have, the first $1,400 of that was completely refundable. But President Biden actually just this year, like basically as soon as he got into office, he enacted the American Rescue Plan of 2021, which both increased how much you can get for that credit, and now the entire amount is refundable. The thing with that is that as it stands right now, it's only planned to be active for 2021. So it's going to be really important if you have kids that you check up on this, do a little bit of research when you're filing taxes for 2022 and see if they extended or revised it so that that tax credit is still active, or if it reverted back to only the first $1,400 being refundable. Also, in case you're wondering, student loan interest is still deductible up to $2,500. If you have that much in student loan interest, you might have other problems, but they haven't gotten rid of that yet. Make sure you're taking advantage of that while you can, because out of everything we're talking about, that one has a much higher likelihood of going away in the very near future. Your mortgage interest deduction cap, that was a mouthful, my God. That was also reduced. So that applies to if you are building, buying, improving, basically anything you can do to a house. That's all stuff you can apply to that deduction, and you'll get that amount off your 1098. Something that a lot of people didn't know about before was that you could actually make deductions for when you're searching for a job or if you're moving for work. But under the TCJA, all of that is gone unless you're military. So you can't make any more deductions for if you are having to relocate for work, or if you're making deductions for while you're searching for a job. You can't use that for a business though. Like if you're relocating a LLC or personally owned business or whatever, that doesn't apply there. There's two distinct things. Now also your local and state tax deductions are not allowed to exceed $10,000, which, I mean, that one is, it only matters depending on where you live. If you live in an area that has a high cost of living, that is going to hurt. That will mess you up. You can get a lot of state and county tax deductions deductions that normally help offset the cost of living in those areas, but now that's going to be capped at $10,000, which can be a huge difference compared to what we were getting before. And last but definitely not least is that your paycheck is probably going to get marginally bigger. It's because one of the primary goals of these tax changes was to increase the GDP. And through these changes, the expectation is that you will see it's marginal, but it is still an increase to what you are going to be getting on your paycheck. All right, lads, thank you so much for watching. I really hope you enjoyed the video. If you did, don't forget to like and subscribe down below. That's the best way to help the channel grow and reach new people, and it helps you know when the next video is coming out. So thanks so much for your support, and I'll see you lads in the next one.